So you're trading and you have a strategy and you want to test it. So how do you do that? You do that by backtesting. So backtesting is the process of testing your trading strategy with historical data to either understand or improve your trading strategy parameters. So the way you do that is that obviously you have your chart that you're looking at, and you want to identify obviously the coin pair that you're trading with. Once identified the coin pair that you're trading with, you need to identify the trading time interval that you're working with. So in this case, you can be able to see that I'm working with the 15 minutes interval. You can be able to see from here I'm working with the 15 minutes trading time interval. So obviously all these parameters, the coin pairs, the 15 minutes trading time interval, all these parameters you selected when you're selecting the particular data that you're working with, which obviously is the first step from the application. So what I mean is your crypto analysis tab. Yeah, you can be able to see this particular tab. That's where you selected all these parameters, the coin pair. Once selected, you'll be able to see the same coin pairs being displayed there that you're backtesting this particular coin pair. Another thing that you need to note is that there's obviously the trading time or the chart period that you're looking at this particular chart from, which means like now there's this continuous white line. This continuous white line is from the 6th of September, and yeah, you can be able to see even the recent values, going forward. And obviously, if you're kind of looking at this particular window, the starting period is this white continuous line, which I've mentioned is on the 6th of September. So yeah, you can be able to work with any time duration that you've selected, but for the case of this illustration, I'm going to work with this time period, in this case from the 6th of September, and then I'm gonna work 3 days from this particular starting duration. Yeah, you can be able to choose your end date to be the current date, which means your backtesting results will be more accurate and also more recent with that particular backtesting strategy that you're trying to test. So another thing, having selected all those parameters, is for you to come over here. Obviously, you've already identified the kind of strategy that you're working with. In this case, let me work with the RSI. So if you're working with the RSI, there's some parameters that you need to key in. One of them is the RSI upper limit. The other parameter is the RSI lower limit. The third and the final parameter is the time period, or generally the kind of candles that you'll be working with, just to compute the RSI. So yeah. So having identified that, I will highly suggest that you use the technical indicators tab for you to be able to understand the upper limit, the lower limit. So to be able to do that, there's another thing that I also need to explain it to you, is that the upper limit is when you'll be selling. You know that from the RSI, computing the RSI, the upper limit is where you'll be selling, the lower limit is when you will be buying. So to kind of get these values, there's this particular feature from the technical indicators tab. You can be able to see the basic technical indicators data. So from this particular tab, you can be able to see there's now the values for the mean, the standard deviation, the minimum values, the 25th percentile, the 50th percentile, the 75th percentile, and the maximum value. So in this case, I want to work with, I'm so much keen on understanding on actually formulating a trading strategy by using the mean, the standard deviation, the minimum, the 25th and the 75th percentile. So how do I do that? I will check on the mean. If I'm you, I will check on the mean. I will also check on the standard deviation, and then try to form a trading strategy from there. So for instance, if I'm looking at this particular RSI values, you can see the mean is on is around 50.979 to be exact, and the standard deviation is 7, so it means plus or minus 7.6. I'll be able to kind of ace my selling point. Another thing that I will also check on is the 25th percentile, because that means for the 25th percentile I will a quarter of all the values will contain somewhere close to 45.4528. And another thing that I want to check on is the 75th percentile, which kind of the 75th percentile is somewhere close to the mean plus the standard deviation. So it means in this case having a value between 55 and 57, I'm somewhere close to the selling point. So that's how I'll actually interpret this particular data to also time my entries and exits on a general perspective. Yeah, you can be able to refine your strategy based on that particular data. So in this case, I've already identified that my upper limit will be somewhere close to the values mentioned. In this case, for illustration, let me just use 50. You know why? From the illustration that I made earlier for the buying limit, which is the lower limit, I will use 45. For the period, which is kind of the previous candles that I will be looking at to compute the RSI, I will use a period of 3. Which is just purely based on some previous analysis that I did. So yeah, you can be able to change your time period and also observe your own strategy results. So having done that, you will see a particular table which will come over here. You can be able to see your trading strategy performance, which is basically this strategy results. And another thing that you'll be able to see is this particular equity curve, which shows you with a capital of about 10,000, that's how your strategy will be able to perform in the long run. Obviously these are dependent on your result or on your strategy parameters. So that's the importance of backtesting your trading strategy. Another thing that you'll be able to see is this particular equity drawdown curve, which is in my case with my strategy is actually good because it's actually above 0, so it's quite better off. It means at least I won't be going to the negative side, which is quite good. So another thing that I've also observed is that with this strategy, the return is higher than the buy and hold return, which is actually the best way to actually work with any strategy, because it means your strategy is actually performing higher than the buy and hold. So just to illustrate all these parameters and how they work, I will start with the starting date and the ending date. So obviously when you're selecting the coin pairs, this is obviously going to be automatic because you selected 3 days from the period between the 6th of September to the 9th of September in my case. It will also change with your case, but in my case I'm working with the 3 days between those particular dates. Another thing that I'm also interested with is the exposure time. So the exposure time kind of says that for every 100 trades in my case, I'll be exposing my capital 99 times out of the 100 trades that I make, which essentially means that for those 99 trades, I'm obviously putting my capital over there for this particular trading strategy. Another parameter is the equity final. So the equity final is what you have as your balance as of this particular end date, having traded your strategy. The last trade will give you this particular value. The equity peak gives you the highest point of your trading strategy. Another thing is the return. So the return is what your trading strategy is giving you in terms of a percentage, which means in my case is actually better than the buy and hold return. The buy and hold return is what, if for instance I bought this coin pair, in this case maybe I bought this Alpine on this particular starting date on the 6th of September. So the buy and hold return means that if I bought this particular coin pair on the 6th of September and it's on the 9th of September, and due to the buying and selling, the coin pair has appreciated 1.467%. So that's the buy and hold. Like I bought at on the 6th of September, assuming, and I sold it at or even held it to the 9th of September. So my coin asset has appreciated, without me doing anything, has appreciated 1.467%. And for these particular trading strategies, it's actually better because you can see, with this particular return, it's telling you that for the person who bought it on the 6th of September and sold it on the 9th of September, you're actually performing better than that person because you have a strategy which is actually higher than the buy and hold return. So that's actually so much commendable for this particular strategy that I'm backtesting. So another thing that you might want to be interested with is the volatility in let me just clarify the return annual percentage return. So what the annual percentage return means for this particular trading strategy, if I'm computing for the whole like for a whole year, the percentage that my coin will have appreciated with is actually higher than the initial capital, because it's actually higher than 100%. So in this case it will actually double my coin pair by using this particular trading strategy. So for an annualized return, it will be 278.01%. So depending on your trading strategy, that's what it will display. The volatility annual is how it will the upside positive returns and the downside negative returns, how they will perform as a percentage. Another thing is the Sharpe ratio. The Sharpe ratio is the ratio between, or basically you have the return divided by the volatility. In this case, we are considering the positive and the negative returns and their volatilities. So that's how the Sharpe ratio is. You can be able to also read more on the Sharpe ratio, but generally it's the ratio between the return and the total volatility. So the other part is the Sortino ratio. The Sortino ratio is the ratio between the return and the downside volatility. So with your return that you got, you can be able to compute the Sortino ratio. The Sortino ratio uses the downside volatility as compared to the Sharpe ratio, which uses both the upside volatility and the downside volatility. The upside volatility, as I mentioned, uses the positive returns that you got. So if so for the Sharpe ratio, it will be both the upside and the downside volatility. The Sortino ratio will just be the return over the downside volatility only. So the Kalmar ratio is another parameter that uses the annual return divided by the maximum drawdown. And actually, looking at this particular trading strategy, I can see it's actually very much commendable, because you can see the ratio that for the annualized return, you divide it by the maximum drawdown. It's actually commendable, because you can see it's very much good in this particular case. So you can be able to work with any with the trading strategy, and you can be able to see how your Kalmar ratio is. Another parameter is the maximum drawdown as a percentage. So the maximum drawdown is the largest percentage decline of your asset from obviously the peak to the lowest point. So it's actually how your strategy is actually performing with the maximum decline, or the maximum drawdown, which is the lowest point. So the other thing is the average drawdown, which is as the name says, the maximum drawdown divided by the number of trades that you're working with. And for the other things, I think they're quite straightforward. So another parameter is the win rate. So the win rate is actually the ratio of your wins to your losses. So in this case, it means for this particular strategy, it means there's no losses because these are 100% wins. Another thing is your best trade. So the best trade, I think that one is quite straightforward. The worst trade, the average trade, maximum trade duration, profit factor, expectancy. I think the other parameters are quite straightforward, but in case they're not so much straightforward, you can always just comment and just tell me how I can be able to even plot for you guys some of these parameters if you're also interested with them. So another parameter that I mentioned was the equity curve. and the equity drawdown. I think those ones I mentioned earlier. So yeah, that's how. So depending on these particular values, yeah, you can be able to tweak. Your strategy, and you can be able to see how it has performed. So let me just change maybe the lower limit. Let me just work with 39 in this case. Yeah. So depending on how you change it, you can be able to get your performance of your strategy. Yeah, you can also work with the standard deviation that I mentioned earlier. You can be able to change, like now the standard deviation for this particular case was about 7. So let me work with even the selling limit of 7. Let me work from 45. 45. Let me just work with 39. So this is another thing that you can also use to compute your strategy. In this case, you can see this strategy is quite good because yeah, you can see the buy and hold return is higher than the return itself. So that to me is actually a very good point. Another thing that I want to check is the equity curve. Yeah, you can see it's also quite commendable, considering this is like 3 days. For 3 days, yeah, you can see you're actually working with quite commendable information over there. So I think that's it. Yeah, you can be able to combine multiple indicators and backtest them individually. For instance, for this EMA, it will buy when the last close is above when the EMA is above the last close. So that's also another thing that you can work with. So the thing that you can change with the EMA is the time period. So for instance, if I'm working with like 2 candles, you know, before I can be able to change that to 2. Another point for you to note is that if you're combining these particular indicators, for the buying and selling, they must meet both of the conditions. So depending on the conditions that you've set. And another thing, just to note about the conditions, once you select these indicators, there's a message which will pop up here below. Yeah, you can see strategy buys when the last close is above the EMA, just to also illustrate how the strategy will is actually performing on the background. It is buying when the last close is above EMA, and that's how the strategy operates. So when the strategy is buying when the last close is above the EMA, it means if I'm combining it with the RSI, the RSI value must be when the RSI lower limit also is also when the RSI lower limit, when the RSI is above the lower limit, that's when I'm buying, and when the RSI is below the upper limit, that's when I'm selling. So that's also quite important for you to note when you're backtesting these strategies, which is quite the way to go. So once you've combined multiple strategies, you can now have a different strategy, which is like a multiple strategy, and yeah, you can be able to see how that particular strategy performs. And having said that, I think that's quite clear. In case anything is not clear, just say it, and I'll be able to respond to you and I think I'm actually through this particular recording. I was recording this when I'm out of the office, but I think you guys are quite good with that particular information. Thank you guys for that. Remember, hit it 2000 and I'll surprise you guys. So do you know what? Subscribe.